what is happiness and what is investment happiness? And effectively, it's exceeding your investment expectation. So the first point of call I want to do is just to try and frame that expectation. If I get one job right today, and one job only, is framing your expectation as to the investment markets. So what I've charted here is the return on the all share, so the stock market, the South African stock market, the return every year since the 1980s, right up to 2016. And the first thing I want you to notice is 30 out of the 37 years is positive, right? So you might not be making a lot of money, but you're not losing money. The UK went through a period like this where there were 3 years of back-to-back negative performance, negative returns. You think this is a tough discussion about low growth? Imagine having a discussion with your wealth manager about losing money year on year for 3 years. And the next thing I want to show you that I've charted here is these red dots, right? These red dots are the intra-year loss, right? So at some point in that year, that red dot indicates how much money you would have lost, right? So if we go to 2009 and use that as an example, the total return for that year was 32%, right? So from 1 January till 31 December, you'd have made 32% on your return, right? Great. But at some point in that year, you would have lost 16%. Now, had you got nervous, banked your money, you'd have lost on the rest of the 16% growth for the year. So nervousness and not sticking to the plan can actually erode value. And if we just look at the average intra-year decline over these years, it's around 16%. So when the market is flat or about 2-3% like we saw last year, some clients were experiencing minus 16 at a point and still stayed invested. So that's the first point of framing expectation. The next one I said, well, if I'm going to frame your expectation, I need to understand how you think. How do you think about markets? So what I've done here is I've charted a fund, and this is the fund performance. Let's call this Fund A. It's a fairly large fund, so it's a good representation of the average South African investor. The next portion I charted was net flows. Now, once again, asset management likes to be super complicated about things, but all this means is how much people invest into the fund. And we're going to analyze this over time to understand how people invest. So here we can see if the line goes up, the fund is doing well. Positive performance, good positive performance. The line comes down, the fund is struggling a bit. So let's see what happens. Fund performance goes down, people take out a bit of money. Fund performance goes up, people add a bit of money. Fund performance goes down, people take out a bit of money. Fund performance goes up and down, and so we go on through the cycle. So what does this tell me? This tells me people like it when their fund does well. They invest more. It's natural. It's human behavior. When something goes well, we allocate more money to it. When something goes badly or less than our expectations, where we take money out again. Right? So now I'm starting to understand how the general population invests. So I decided, let's build this portfolio. So if this is how everyone invests, let's build that portfolio and let's see how they've done. So what I've done here is the previous best portfolio is going to be charting in blue. And basically what it means is at the end of the year, New Year's resolutions, you take out your newspaper, go look down there, what's the best fund of the year? Allocate all your money to them, right? Invest 100% of them. Keep that money for the rest of the year. At the end of the next year, take out the newspaper again, have a look. Who's the best fund manager? Disinvest with the previous one, invest with the best fund manager. And so you carry on for 10 years. So let's see how it would have gone. So you'd have invested, gone through the cycle, you would have ended up with your 100 Rand that you invested, you end up with 200 Rand. Say, bloody hell, that's good. I doubled my money. That's clever investing. So I said, okay, well, if that's the fact, we need some sort of benchmark. We need to be able to compare this to something. So I said, let's take a passive investment, a tracker of the market of which this investment would be, and we say, that's sort of mindless investing. I mean, there's really no thought in passive investing. You're just following an index, right? 100% invested in an index versus this previous best. Red chart. So here we can see, had you just followed mindless investing, no thought, followed the market 100%, you'd have ended up with 230 Rand. You'd have made 30% more than following the previous year's best asset manager. Right. So what does this tell us? This tells us by just chasing historical performance, you're actually going to erode value.